Don Kaufman here, September 24th, 2021, doing the TheoTrade weekend update with about 30 minutes left inside of the trading session here on a Friday afternoon after what can only be described as just a downright wild range on the week. But we're going to be very forward-looking here in this weekend's update and try to answer the question, will rising interest rates start to really pressure markets moving forward? Again, that and much more here. Let's kick it off with just a brief market update. And to get into this market update, you got to talk about some of the range in the overall week. To do that, we're going to look specifically at the SPX, the mother of all products. And I'm actually going to cruise over to the daily chart here. One of the first things I will bring to your attention from absolute high to pretty much where we are right now. I mean, we touched down almost to 4,300 inside of the SPX. We're trading right now at roughly, we'll call it 44.60. My, oh my. You know, what a difference a week can make inside of a marketplace. That's a 160-point range. Now, overall, the options marketplace was looking for plus or minus about $95. That was this week's expected move. We got that and then some. And I love to point this out because this, again, the option market depicts risk for the forward week. And we'll look at that again here towards the end of this weekend's update. Nevertheless, for this previous week of trade, we're looking for a $95 move. Actual move somewhere in the neighborhood again of about 150, 160 points inside of the SPX. So we shattered the lower edge of the expected move, came back in, put net, and I think this is probably one of the more shocking aspects of what I term a wild range on the week. When you go down to the 1 minute, this is again an intraday chart. Now, mind you, we still have 27 minutes left to play inside of this trading week. See this line right down the center right here? That's where the week began. We had to get everywhere to get absolutely nowhere. Right now, the S&Ps, though, are poised to finish the week. Just the S&P is poised to finish the week very, very mildly higher. Who would have thought after, again, that Monday sell-side activity that we'd be talking about just a few days later, finishing the week higher? And, of course, that's when all the buy the dippers are going to come out of the woodwork and be like, I knew it. I knew it. I had the dip with me. So the next dynamic that we need to talk about, okay, in this week of trade, it's not so much finishing the week higher, some wild volatility. All right, there's starting to be a little bit of a cause for concern, and it's going to be one of the key points that we're going to make in this weekend's update. It's about bonds, it's about notes, and it's about interest rates heading up. And what we're actually referencing in this case is following the FOMC meeting, which of course was Wednesday. You know, the FOMC announcement itself didn't really have that dramatic of an impact, neither in the S&Ps, nor did it have much of an impact on the bonds. And right now you're looking at a forward/ZB. And of course the FOMC meeting was right here. So we migrated a little bit to the upside. All of a sudden, lo and behold, during that wild rally in the S&Ps on Thursday, the bonds sold off substantially and have actually had some follow through. So it doesn't seem like all that much. You're like, whatever, man. So they're kind of, protruding to the lower end of a range. But take a look at this as it relates to the 10-year interest rate. You're going to get a little bit of a different feel. When it comes to the 10-year interest rate, the 10-year interest rate actually broke out above the 1.4% range, and it's skyrocketed. And this now is a little bit of cause for concern and something, again, we're going to discuss here momentarily. But in the market update, I just want to position the fact that this breakout to the upside inside of interest rates is, this is going to be, again, the object of our affection kind of moving forward. So the bonds and the notes are in effect doing what the Fed didn't, and that is raising interest rates. So if you listen to a little bit of the Fed, the Fed was like, we're possibly one day, maybe, possibly, could be. I mean, they used every hedging word they possibly could to say that they're going to begin tapering, but they're not officially even going to mention tapering until the next FOMC meeting, but then they're going to start the tapering possibly, in November. We'll see. Again, hedging in terms of their statements. Hedging statements everywhere. And at the exact same time, the marketplace, they did mention inflation, and the marketplace actually took interest rates up. So I look at this as, the marketplace being the interest rates are actually doing what the Fed did not at this point in time. The other aspect really worth mentioning here has to do with China. And we've been talking about Evergrande, whatever you want to call it. Okay. Is the risk contained at this point in time, and what are the markets really saying about this? One of the things that I've been kind of pointing out throughout the course of the week. So again, on Monday, you get this kind of unprecedented sell-off. And I call it unprecedented because, again, everybody knew about that risk. I mean, literally weeks ago, and all of a sudden it strikes and there's risk, and then we kind of rally back up inside of the S&Ps. It's okay, everything's going to be just fine. The one thing though that I found interesting about this, and I don't think enough people are actually talking about, take a look at how this relates to expected move. Okay, so if risk kind of hits the fan with Evergrande in China, the spiders, well, they actually reacted, all right, throughout the remainder of the week very, very positively. What's interesting, though, about it is if you took a look at the QQQ at the exact same expected move, the Qs, even though they did rebound nicely, the Nasdaq actually is going to finish the week ever so slightly lower. And I found this very interesting, simply to respect the fact that, again, why is the Nasdaq, failing, if you will, to recover where it probably didn't have the risk to China in the first place, at least not nearly as much risk in terms of the S&Ps. And I'm a little surprised that the Nasdaq didn't necessarily recover. One of the reasons, okay, we suppose, is that, again, rising interest rates, which we're going to cover here momentarily. But again, I wanted to just, paint a little bit of the market update. And, when it comes to the market update, we could talk about volatility until we're pretty much blue in the face. Like volatility this week, it exploded, it contracted, we laughed, we cried. But at the exact same time, okay, all of this volatility was a wonderful opportunity, and we did take advantage of that opportunity to not only sell premium in the midst of some, 25, 26, even hit into a 28 VIX for a brief and fleeting moment. We did sell some premium, and that premium, the volatility contracted so much so that we've already covered most of that premium, which highly unusual. We also saw the volatility futures, okay, go from just a very, very, very steep kind of contango into a brief, again, in fleeting moment of a backwardation. We're nowhere near that anymore. Backwardation is when this short-term volatility future actually did eclipse, again, the longer duration volatility future on Monday and then fell back out. But look at the distance again. People, again, there's some unprecedented things going on in terms of volatility and the resilience of the marketplace. Nevertheless, okay, moving forward, well, we're still going to have some cause for concern, and that's exactly what we're going to be discussing here. So, obviously rising interest rates, which I'm going to talk about here momentarily, okay? But we want to reiterate, you got to get, your volatility game face, keep it on at this point. And I would keep that volatility game face going until we see, all right, what these bonds are in effect likely to do. So let's now talk just briefly about why we should still expect degrees of volatility. And it's not coming from where you think it is. When we can talk about China and the contagion and so forth, but again, I want to push that aside because I think it's all conjecture at this point. I think it's also probably a lower probability occurrence. What is a much higher probability occurrence, at least at this point in time, is the bonds continuing to sell off. And the bonds continuing to sell off. And again, the relationship between bonds and interest rates. So whenever I bring up the bonds, okay, the bonds are the 30-year. You can actually look at what's called TYX. TYX is actually 30-year interest rate. You can see it picking up a little bit. But the cause for concern is never really in the 30-year interest rate. The cause for concern is usually typically in the 10-year, which is the TNX. And you see, again, the TNX actually breaks out to the upside. So one of the first things that I want to bring to your attention, and again, why I think we're still going to have high degrees of volatility, is what I term interest rates versus tech. All right, in this case specifically, and I'm actually going to walk you through exactly how to do this, I'm going to go ahead and close up this left side bar, and I want you to look specifically at the TNX, because what occurred early on in this trading year, and again, this dashed line over here, right, that dashed line is right to the beginning of 2021, rates effectively took off, all right, and again, this is interest rates, and maybe you haven't looked at it before, because if you look at this, it says like 17.65. Yep, that's not the interest rate. The interest rate is 1.765. That's just how it's quoted. So again, earlier in the year, the interest rate effectively took off to the upside and kind of meandered a little bit lower, and all of a sudden now we have this big breakout once again. The question is, you ever actually done a comparison chart, and a comparison chart between the TNX, and in this case, I'm actually just going to throw up the QQQ, just to make it easy, to make it clean, to make it wonderfully clean. We're just going to come down over here to where it says studies. We're going to go to add study, go to compare with, and it cruise up to a custom symbol, and just go ahead and type in QQQ. And whenever you do a comparison chart, you want to change the style of your chart, change the style of your chart. Okay, from candle, change it to line, so you can see line against line. All right, so Exhibit A, which is, of course, right here, this is the percentage interest rates. That's the TNX. Exhibit B, of course, right here, would be none other than the QQQ. And one of the things I want to show you is a little bit of ebb and flow, and this is not like a perfect inverse correlation, but the aspect that should really resonate with you. Here's where interest rates really started to accelerate, right here, which is pretty much right where we are. And take a look what happened to the Nasdaq. It tanked at that point. I mean, the Nasdaq really took a hit. All right, now the Nasdaq is all the way up here in Never Never Land, and yet rates are right in that same area. So it is a degree and a cause for concern. And again, this is not like a perfect mirror image. This is not like a perfect negative correlation, but there's no question that a rising rate environment, and the rates literally broke out to the upside today, should put pressure forth into the Nasdaq here in the very near term. And I think that if this is going to occur, it may show its hand as early, of course, as this next week, which once again brings us, all right, to some of the tech titans here. I'll snap back out of that chart for a second. So I reiterate, get your volatility game face and keep it on at this point, because I don't think that volatility is far from over. So the underlyings that have been kind of, again, the object of our affection continue to be stocks like NVIDIA. And if you haven't heard this, this is about the third week in a row I've actually covered these. If you look at stocks like NVIDIA, again, it's always important to recognize that markets are incredibly cohesive. And what I mean by that is, like, you just can't look at a marketplace like in autonomy anymore. Like, oh, let's look at NVIDIA. Okay. No, let's look at NVIDIA. Okay. In comparison to, for instance, the QQQ. So NVIDIA is up 68%. All right. 68% on a year-to-date basis. It's unscathed. Except if you look at the QQQ is only up 20%. So obviously NVIDIA is drastically outperforming. Now think about this. If we started to have a little bit of a degree of issue with, of course, interest rates, and the QQQ was to sell off, okay, what would probably have to perpetuate and lead the sell-off would be the high flyer, NVIDIA. What else is up there with it? Google. Google's up 65%. Again, if you look at Google and you compare it to the QQQ, you're like, oh, whatever, man, so it's on the leading edge. No, you're missing my point here. My point, if you look at stuff like Apple, Apple is actually on the lagging end. Apple is actually hurting the performance of the QQQ, okay? I'll further that. Go take a look at Amazon. Amazon's barely up on the year. It's only up 7%. It's a drag on the marketplace, right? So you look at something like Tesla. It was like, yeah, what about Tesla? Tesla's only up, what, 5.5% on a year-to-date basis. All of these are actual drags. When I say dragging, they are on, the laggard end of the QQQ in terms of performance. They're not helping the performance. There's only a handful of stocks helping the performance. Microsoft's up there, okay? Microsoft's up there, no question about it. Facebook was up there. I mean, Facebook was one of the stocks that we said is the object of our affection and came off, hard and fast. In fact, Facebook is going to end the week right at the lower edge of the expected move. Okay. We brought up Google. We brought up NVDA. These are the stocks. Like, this is it. If the Nasdaq is going to see sell side activity, it has to occur. Okay. In these underlyings. Obviously, again, Facebook already took the brunt of a hit. It's one of the reasons specifically that the QQQ is actually underperforming. Remember, we raised that question just a little bit earlier. If you looked at the QQQ versus the spiders, interest rates is definitely already starting to drag a little bit on the Nasdaq, but it's Facebook in a big way. And we wanted to kind of delineate that because it's big league. Now, think about that moving forward. Again, I would say that the coming of next week, we want to keep a very, very close eye on bonds. Bonds continue to sell off. Somewhere in the sell side activity of bonds, we would reach a degree at an inflection point where it almost feel like technology is going to snap a little bit. Okay. In the meantime, financials, which I'm going to talk about here in a moment. All right, financials have actually ripped to the upside because what do financials love? They love higher interest rates. I'll come back to that here in just a moment. Before I get there, okay, I wanted to also bring up a few Dow-related stocks, and again, some positions, if you will, that I've taken in some recent days. All right, the reason I wanted to bring up Home Depot, I had a lot of conversation earlier this week. If the market is going to sell off and sell off considerably, where might I want to be? Okay, long or short, positions. One of the underlyings, though, that has really kind of come through belongs in the Dow, and it's specific to Home Depot. So we were talking a little bit about long short positions here, and again, I'm going to switch gears for just a moment. Okay, Home Depot, it's one of the primary constituents inside of the Dow. If the marketplace as a whole is to actually see degrees of sell side activity, which at this point, again, we've rallied back up. We're doing much better today than we probably ever considered. Again, volume kind of dropped out. Nevertheless, market's still perpetuating a few more gains. But if we're to see some sell side activity, you want to look right now at some of the top performing stocks, specifically inside of the Dow. Why the Dow? Like, why am I not focusing on the S&Ps? The Dow is a price-weighted, again, a price-weighted, okay, product, which means, all right, for every dollar, okay, that a product would move, and I say a product like a Home Depot or a Microsoft, a Salesforce, for every dollar it moves, okay, that dollar would influence the Dow by, let's say, in this case, I'm just going to average, okay, about 7 points. So you get about 7 points of Dow movement, okay, for every $1 move, regardless of which stock it is. So obviously, like Walgreens, I mean, Walgreens could move like, $3, which would be a huge percentage move for Walgreens, but that would do absolutely nothing to the Dow. It would be like, a whopping 21 points. But if you start looking at this, and why am I actually keying in specifically to Home Depot? Because if there's going to be some sell side activity to the broader marketplace, Home Depot, okay, is pretty much ripe for the plucking. It's basically sitting at all-time high. Now, if you actually compare and contrast, all right, Goldman Sachs in here, Goldman's a little bit off some of the highs. Take a look at even at United Healthcare. United Healthcare towards like a lower end of a range, not too exciting over here. But Home Depot would have to unequivocally see some strong sell side activity if we were to go back into kind of a fit of rage inside of the marketplace. And again, this is where people kind of question, well, if you sell the S&Ps off, okay, the Dow is going to move in relationship with it. Remember, the marketplace is extraordinarily cohesive. So if the S&Ps, let's say, dropped by like 5%, unequivocally, the Dow would probably drop by 5%. But it doesn't necessarily work that way into specific underlyings within, okay, within the Dow, all right, where the top performers in the Dow will likely heavily underperform in the midst of Dow sell-side activity. It's something to think about, okay, and I will cover much more of this in this coming week here at TheoTrade. Switching gears once again, and I just, again, wanted to provide a little bit of an idea for you because there's a few different trades that I'll be executing early on in the week specific to Home Depot. All right, other trades that have actually put on this week, the rip back to the upside inside of the financials, it's just uncanny. This is one where, again, I have to pull up auto expected moves just to be able to get a full brunt of the feel for how much volatility has been in here. The financials literally cracked almost 2 deviation move outside the expected move, only to end the week almost back to the upper edge of the expected move. This is where, clearly everybody's like, sounding the all clear signal in terms of China at this point, which might be a little bit premature. Nevertheless, okay, there's also an effect that the bonds, if they sell off, that brings rates higher. Higher interest rates, again, are wonderful for the financials, as I was saying. Okay, but there's also an inflection point in here. If we continue to see heavy sell-side activity inside of the bond market, it's likely to negatively impact some of tech. You start to pull down tech, and it'll actually start to roll the financials with it. At this point in time, I've actually taken a couple of degrees of bearish positions inside of the financials. Nothing too crazy here. A couple of in-out spreads. You can see some contract size that we actually pushed through on the financials, and this is still 35 days out. Again, this is not like a wildly bearish position. Nevertheless, just looking for a short-term kind of pullback in here, or just some short-term volatility, and it'll be enough to be profitable and get us home in that particular position. Some similar ideas that I'll be throwing at you early in the week on Home Depot. A couple of similar ideas in a few of the tech stocks, of course, including NVIDIA, where I've also taken a degree of a position inside of NVIDIA. This one's about 28 days out. Again, looking for some more, tumultuous volatility to kind of play out over here. Once again, coming into this next week, you got to watch the bond market. The bond market right now, you just feel like everybody got out of this week completely and totally unscathed. Everybody's high-fiving each other. Be careful, okay? Rising interest rates. This starts off very, very slowly. Most retail clients don't look at rising rates as being a big issue, but I'm telling you right now, that's not just going to be a big issue. It's the issue right now. If we continue to see the TNX break out to the upside, it would actually be a little bit of a tech disaster. We don't know exactly where the inflection point is, but I can tell you one thing: hitting like 1.5% inside of that TNX would probably break the spirit of many a trader out there. Last but definitely not least, the SPX Expected Move. So we still have about 6 minutes left inside of the trading day, but just want to give you a quick update. Again, we just came off, 2 really volatile weeks, right? So we had a week where we had back here 2 weeks ago, that was actually like a $117 expected move. Last week, we had a $95 expected move. So the volatility contracted a little bit. So how much did it contract? Well, there's something kind of cool, interesting, if you will, to discuss on here. If you look at the SPX in this next week of trade, you've actually got a Monday expiration, a Wednesday expiration, a Thursday expiration because it's a quarterly, and a Friday expiration. So you've actually got 4 expirations throughout the course of the week. Incredible, though, to see all the different expected moves. We're probably going to sit on an expected move. Expected move is going to be plus or minus somewhere around $70. Again, this expected move, that again, it gives us a feel for risk moving into next week. This expected move, it is not decisive. It is not set, in stone until precisely, 4:15 Eastern time on a Friday afternoon. So we ain't home yet. We just figured we'd get ahead of our start on the weekend and some low volatility over here. But look for still about a $70 expected move. How does that compare to some of the previous weeks back here? Listen, we're still in the midst of some decent amounts of volatility, and I would look for every dollar of that $70 to happen in this next week of trade. Again, watch bonds early on in the week. I mean, you might be watching them on Sunday night when the marketplace reopens because, again, if volatility is coming, it's coming from the rising interest rates. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.